Hello, and welcome to our latest MoneyShow Money Masters podcast. I'm Mike Larson, Editor-in-Chief with MoneyShow, and I'm coming to you from the Investment Masters Symposium in Las Vegas with Lindsey Piegza, Chief Economist at Stifel Financial. Lindsey, how are you?
I'm good. Thank you for having me.
Thank you for being here. You are talking about the economic outlook here on site. So I guess I'll just throw the first question. What is the economic outlook? Where do you think we are in the cycle?
I think it's pretty uncertain at this point. There is a lot of optimism that we will be able to withstand further rate increases and avoid a significant downturn in the labor market, thus achieving that utopic soft landing. But we're already beginning to see some cracks in the data that suggest it may be a more difficult pathway to achieving that unicorn scenario, especially if the consumer continues to lose momentum.
Got it. Well, I know you were on that fantastic panel earlier about the Fed and what the outlook is for policy there. So what do you think the Fed has left to do here? You seem to be a little more on the aggressive side in terms of how many more hikes you expect and what kind of economic fallout there might be from that.
Well, I think it's very clear that the Fed is trying to achieve price stability. And unfortunately, we haven't seen that come to fruition quite yet. Now, we've seen a market decline in price pressures. That's a step in the right direction. But it's not about going from 8% down to 4%. It's about continuing that downward trajectory to the targeted 2% level. That suggests the Fed still has more work to do. Now, it may not be significantly more work to do, but at least one, maybe two rate hikes by the end of the year.
Okay, one, maybe two. Let's talk about the employment data that's been out. I mean, obviously the numbers are still decent, but clearly there seems to be cooling in terms of the number of jobs created. Some of the JOLTS data has gotten a little bit softer. Where do you think we are in that process? I mean, the Fed won't come out and say we want higher unemployment, but obviously it's sort of part of the playbook.
Well, they're not targeting higher unemployment specifically, but to your point, as the Fed continues to raise rates, they're looking for the economy to slow. They're looking for the labor market to slow. And then we achieve that lower level of inflation. So that really is the intended effect. We have seen hiring cool somewhat, but that being said, we're still seeing hundreds of thousands of Americans put back into a position of gainful employment on a month-to-month basis. And of course, the latest July report showed unemployment ticking down, the exact opposite of what the Fed wants to see.
Sure. We have the inflation data again that's getting better, but not strong or not weak enough, I guess is what I want to say. How do you, when you project that out, I mean, when do you think we're going to get to a point where we're going to have that 2% or quasi 2% number that's sort of the holy grail here?
Well, it's interesting because the Fed said we'd presumably stop raising rates when we're close to 2%, and we'd start cutting rates when we presumably get closer to that 2%. But we don't expect to get to 2% until 2025 or beyond. So even the Fed itself is pretty realistic in terms of the timeline that it's going to take to return price stability.
In the time we have left, I know, what do you think about some of these sort of fringe scenarios, or not fringe scenarios, but some of these things that could come out of left field? We had the warning about bank balance sheet quality and commercial real estate loan risk, and the SLOOS data from the Fed showed some tightening of credit. How much of an impact do you think that has in the next, 6 to 9 months?
Well, when we talk about policy firming, it's really a combination of an organic change in credit conditions along with further rate hikes. So the more that we see this change in credit conditions, the less pressure there is on the Fed, because the market's going to be doing some of the work for the Fed. So if in fact we do continue to see tighter lending standards, maybe we only need to see that less aggressive one additional rate hike scenario come into play.
Excellent. Okay, well, Lindsey, I really do appreciate you taking some time out to chat here on a busy day.
Thank you very much.
Take care. Thank you all for watching.